Hello and welcome to the Lead Left Presents M&A Outlook for 2022. I'm Randy Schwimmer, publisher of the Lead Left and co-head of senior lending at Churchill Asset Management. I'm joined today by four top investment banking veterans who I'll introduce in a moment. We are very fortunate to have over 500 registrants on the call today, which is being recorded for later playback. We also want to welcome our media friends. This webinar is on background only, so any quotes from our participants must be approved by them. I've been on dozens of panels over the past several years, but most have talked about the deal financing rather than deal flow drivers, and none had the lineup that we have today. So let me start by introducing the panel. Justin Abelo, Managing Director at Houlihan Lokey, Dan Connolly, Head of M&A at William Blair, Bruce Kelleher, Managing Director at Harris Williams, and Bobby Reifman, Managing Director at Lincoln International. Gentlemen, thank you for joining us. So let me start, Bruce Kelleher, with you. Before we talk about 2022 and the year ahead, I'd like to get your views on 2021. It's not that long ago that we were wrapping up that incredible year. Talk about what 2021 was like for you and your firm.
Sure. Thank you, Randy. It's great to be with you this morning, and it's great to be with the other panelists as well. And thanks to everyone who's on this session. It's good to be with you. I think it's instructive as we think about 2021 to look back to really the last several months, last quarter of 2020, because 2021 in many ways was a continuation, if not acceleration, of what we saw in the fourth quarter of 20. So it's really a story of 5 quarters in many ways. I mean, after the strong bounce back following the COVID-induced slowdown in the second quarter of 2020 and into the third quarter, we all saw, and I'm sure it was certainly true of Harris Williams, and I suspect it was true of my fellow panelists, we saw a significant uptick in activity as we entered the late summer months. And post Labor Day, M&A activity really returned in force. And so we saw a rapid acceleration throughout the fourth quarter, each month of the fourth quarter in 2020. And after really, I think everybody had an opportunity to catch their breath in the early part of 2021, post holidays, really that activity resumed, and it resumed in full force. And we saw at Harris Williams a continued acceleration throughout the year of activity. And I think what was remarkable to us was not just at a macro level, the M&A volumes that we saw, but it was also really the breadth of activity across all of our sectors. We have 10 industry groups at Harris Williams. Each one of those groups saw that trend continue throughout the year, and that is an acceleration of M&A activity to really record levels. So each one of our 10 industry groups eclipsed their prior record. In many cases, that was 2020. In the late summer months, kind of September timeframe of 2021. So we were sort of deep into new uncharted waters from a deal volume perspective by the time we entered the fourth quarter of the year. So it was really the breadth of activity across our platform, as well as the consistency of activity throughout the year. We did see in the latter part of the year, latter part of the fourth quarter, November and December in particular, a little bit of a slowdown in new deal launches. And I would not confuse that with a slowdown in the overall market, because many of the buyers, sponsors, and corporate buyers alike were all hands on deck trying to get deals done prior to the end of the year. So on the margin, fewer deal launches in the last, call it, 45 to 60 days of the year, but a heightened level of deal execution and deal closing activity, throughout, the end of the year, and as we begin this year. So I know we're going to spend some time talking about the factors that contributed to that activity. I think one point of note before I pause is kind of how, not just how active the M&A markets were, but how we all got so many deals done. And it was kind of remarkable, and I think we'll look back over time, and candidly marveled the fact that much of this was done in a remote environment. Many of us returned to our offices in the latter part of the year, but still, for the bulk of 2020 and deep into 2021, whether it was pitches, management presentations, other meetings throughout a deal life cycle were conducted in a remote manner, which had an impact on essentially increasing our deal team's capacity to execute deals. So I think we'll see as we get deeper into 2022, and I think we're going to talk about this for the course of the hour, as we sort of resume some degree of normalcy, if you will, in terms of deal execution, how that impacts capacity in the system. But there's no question, as we reach the end of the year, uh, the market was highly strained, and we saw that in terms of third-party service providers. We saw that in terms of our own people being taxed. So, hopefully, as we enter 2022, we have a little bit more of a normalized level of activity that's putting less strain on the market. But I'll pause there, Randy.
Yeah, thank you, Bruce. And of course, we're still a little bit remote, starting off with 2022, but hopefully that will change as the year goes on. Dan Connolly, you've heard what Bruce has said about 2021. What was your view from where you were sitting last year?
Yeah, Randy, thanks for having me, and thanks to be able to join this great group of panelists. What Randy described was very much our experience as well, in terms of the momentum and the acceleration of our business in the wake of the pandemic. And recall, we'd actually been enjoying kind of record levels and volumes up until the pandemic. We did have a bit of a pause in Q2 of 2020, but even at that point, leading into March of 2020. There was, the many factors that were driving this great M&A environment, but at its core, it was just a massive amount of very, very cheap capital chasing a limited amount of quality investment opportunities. And once everyone took stock of what the market was going to do, we had this massive influx of liquidity by the very aggressive action of the Fed, which kept the public equity markets still functioning and very liquid and maintained valuations across the public equity markets. That, I think, kind of brought back courage to many of the private capital investors that's been such a source of fuel for this overall volume that we've been experiencing. But fundamentally, the continuation of what we had going into the pandemic is continued since then. That is, we just have massive amounts of capital, whether it's on the balance sheets of corporations, sitting within institutional investors in public equities, as well as just an overwhelming amount of capital that's been raised by private equity over the last several years and continued to have been raised throughout the pandemic as well. All those dollars are seeking alpha in the market today. With that combined with very, very low access to additional financing capital as well. So that continues to fuel, and so you have a very high valuation environment. You need to justify those high valuations. In order to justify those high valuations, you need to invest in growth. And so you necessarily, in looking at growth, you need to look at the potential for M&A. And so we have been feeling that, and just as Bruce pointed out, we saw sectors that were at the forefront of the emergence since the pandemic, primarily within tech and healthcare, but really software. That's what we saw at first. But we have since seen that momentum and that trend extend to every one of our industry groups, and frankly, every one of our product groups as well. And so, and that fundamentally, just that the basic availability, supply, demand imbalance of capital and investment capital and investment opportunities, that still remains. And I think it gives us reason to be bullish as we move into 22, that this trend is going to continue because that imbalance remains. And we have seen, despite maybe a little bit of a digestion at the end of 2021, we've seen buyers be very engaged moving into 2022. So, it's been a long time since we've really seen a pullback and a real recession. But we feel very bullish that these trends are all, these fundamentals are such that there's a lot more runway to go as we head into 2022.
Interesting, Dan. Thank you. So Justin and Bobby, maybe starting Justin with you, talk about 2021 and how the auction processes changed. I think Dan and Bruce kind of alluded to that in terms of obviously the issue of being remote made it more challenging, particularly in the beginning of the year. I remember, one private equity sponsor in middle of 2020 saying that he was very active for deals that only required a few hour drive from his house. He was able to get those deals done, but it became more challenging. Talk if you will, a little bit about how the auctions changed and where we are today a bit with that, and then I'll ask Bobby to talk about that as well.
Yeah, thank you, Randy. I think Bruce and Dan are dead on that the market hit its capacity effectively sometime in the late summer. The market for corporate control, it might have passed that capacity, and you could sort of hear the sounds of the cables creaking and straining. Bankers were turning down deals, which really goes against our DNA. It's sort of the sign of the end times. There was a 6-week or so waiting list to find any accountant or consultant or banker to do QOE or sort of buy-side diligence work. For love of money, you just couldn't find someone. And the PE buyers, who for basically a generation now have effectively provided a valuation put in the market for corporate control, were really threatening to become too busy to be effective, and that valuation put was threatening to fray. So it was actually, I think, a pretty interesting and fraught time, and we all worked through it remarkably successfully. But in the meantime, one sponsor told me they saw more than a half year's worth of deals in a single month. Another large cap sponsor had sent me an email thanking me for a call on a new opportunity, but saying, this was in the late summer, saying, no, thanks, we're not going to look at new deals for the rest of the year. That was, I think, in August, and one of the top 10 industry team and one of the top 10 global sponsors. Sort of a remarkable thing to say. It's an even more remarkable thing to put in writing. I think it's an even more remarkable thing to put in writing to me. I'm sort of the last person maybe in the entire world you should say something like that to, given what I do for a living. It's a pretty remarkable thing. So all buyers were really focused on choosing their spots. And that meant that the buyer universe for any given asset was materially thinner than it had been. The good news was that the buyers that remained were high conviction buyers who had a willingness to be very aggressive on values. And indeed, valuations went up materially during this period. The bad news is that there weren't as many of them as there was a while ago, to quote the old song. So sell-side process design really had two conceptual paths to take to accommodate that basic fact. And we as a firm, and I think all of us on this panel, we as an industry probably pursued both of these paths. The first was to allow a small and curated group of buyers differentiated access to deals early on. That's early looks or fireside chats or platinum card meetings or whatever terminology you want to use. I think all of us have our own adorable little terminology for that. But early introductions to management, either standalone or as part of industry conference programs, early access to data room style information for selected buyers, et cetera. The second path was really for situations where we wanted a broader entrance to the buyer funnel, maybe because the nature of the asset itself made it harder to identify the best buyers, harder to figure out who that small list should be, or because the ownership dynamic of the company we were working for made a more fulsome price discovery mechanism desirable. And in those cases, we conducted a regular sort of by the books auction process on the front end, but then added one or more, usually with a pretty rapid cadence, confirmation or check-in bids after the initial indications to give buyers the comfort that they were in a narrower process and could therefore spend money and time on due diligence. They weren't afraid to commit. And conversely, to give sellers the comfort that they were dealing with the most engaged counterparties. And which of those two paths we took really depended on facts and circumstances, but they had the same goal, which was to sweep away the superfluous and retain the essential.
That's really interesting. And I'm going to be listening to the recorded version of this to capture all that because there was a lot there. Bobby, let me turn to you and maybe feed off a little bit of what Justin's talking about. What were some of the notable things that you noticed in the auction phase that was different from previous years? Somebody told me about this issue that they had never seen so many multiple price adjustments during processes as they did in 2021. Talk about what you've seen that was different.
Yeah, so as you think about valuation, I mean, historically, we all know the approaches everyone takes, whether it's quantitative in terms of your LBOs and DCFs, or the qualitative and public comps and M&A comps. But 2021 kind of completely created this new dynamic, and it's what Justin was getting into. What was on everyone's mind was kind of the competition and resource allocation, just given the deal flow that was out there. Buyers were picking their spots a lot more carefully and less willing to chase assets as kind of a large auction process. So to your point about the price changing as the process was going, is because people were either committed or getting out of the way. It was very tough to get people's attention in the crowded market. But those that you did get the attention were willing to pay that extra turn or two of multiple in order to really take that business off the table. And so you get to that point of you have a certain price to play, and then it came to the point of, hey, we only want to keep spending the resources and time if we know we're going to win this. So we're willing to step another level higher in terms of value. There's also an element that came into play that was very interesting that a lot of the other panelists can speak to that have seen in terms of the trust becoming very valuable. The buyers were spending a lot of time going to the bankers and asking if it was worth their time. The number of conversations we had where people said, hey, we love this business, but is it worth us spending the time? Transparency became actually a key part of those processes in order to get people engaged. Because if people didn't feel they had a real shot, if they felt that they were going to be a stalking horse, they eventually just stepped back and said it wasn't worth it, even if they were at a very competitive value. So it got again to that dynamic of not just what the intrinsic value was of the business from all of the classic old school ways of valuing it. It really became a number of, and I heard this with one of my deals, where it no longer became what the business was actually worth in their mind. It became what would it cost in order to make sure that they bought it. And that's what really drove those values during the year. As Justin hit, the most fascinating thing we saw was you saw a lot fewer bids on average, but much more aggressive from the top. So prior deals that may have gotten 25, 30 IOIs would only get 10 or so. But even despite the fact you had less IOIs, what you did have was more competition at the top and higher prices in the end. And it wasn't just the valuation that was driving some of the outcomes here. People were moving very quickly. I'd say our average deal in terms of from launch to close was much shorter in 2021 because people were looking for ways to not get lost in the weeds. People were willing to go past doing full Q of E's, going through all the diligence you typically see from the confirmatory in order to get it done. Very often we were having processes where we'd have check-in bids, post MPs, where people would come in and say, hey, we could sign a contract within a couple of days here to get it done. So that really became a lot more seller-friendly contracts as you think about the deals getting done, happening very, very fast from that perspective. So it's very fascinating to see how those dynamics, because of the crowdedness of the market, of what it took in order to get it done. Another outcome of this process is really, what's happened with buyers is they're spending a lot more time proactively identifying targets early. They don't want to go into processes that they've had no prior engagement with that business. So they're learning about it for the first time because it becomes not worth their time. They feel someone else has done that. So how competitive can they really be? So there's a lot more building relationships early on with assets. And the ones that are very successful in getting those A type assets are the ones that have been in front of it for a number of years. You hear often the time why people are declining again is they don't have an angle. They don't have that approach to make sure they win it. So therefore, these aggressive approaches, quick processes are only going to grow in 2022 because it kind of builds upon itself. They're seeing why they're losing, and people are taking that and going and doing more time spent proactively looking at businesses, getting to know them so they can do that at the next process to come. I'd say the one downside of the last point here from kind of the outcomes of this is expectations from sellers have also ballooned. There's the typical success bias. You hear about the story of the big winners. You don't hear about the ones that either execute as expected or below what was expected. You hear about those huge wins. And what we've been seeing with a lot of buyers is expectations, even for those businesses that may not be the A+ businesses, are expectations in this market of getting that A+ type value.
That's
Hey,
interesting.
Randy,
Yeah.
I may jump in if it's okay,
Great.
and just kind of amplify a couple points that both Justin and Bobby made, because I think they were spot on. And that was, we saw throughout the year, and this is true, irrespective of the market cycle, but we saw throughout this past year just the premium placed on relationships with our sponsor clients in general, but we're all in the business of calling on and working with private equity groups. And Bobby made the point that the sponsors would really lean into their banking relationships to understand, do they have a realistic opportunity or shot at prevailing in any given transaction, and the ability to have a candid conversation um, with bankers, between bankers and sponsors, I think was at a premium last year in a big way. I mean, as busy as the year was from a transaction point of view, I'm not sure there was a year that I can recall where there was more of a premium placed on the relationships that you have with buyers. Because again, we are in the business of serving our clients, right? And we need to make sure that our clients, both those that we're representing in a process, but also sponsors in general, realize and believe that we are looking out for their kind of strategic best interest, and they're not going to waste time on a transaction where they really have no practical chance of prevailing. So we want to make sure we're mindful of our client, who we're working for at all times. But man, there was a huge premium placed on the relationship between sponsor and banker last year for sure. So I
Yeah,
mean, I would just echo Bobby's comment in that regard.
yeah, and we certainly saw it on the financing side. Dan, let me get you in on the conversation on this. One of the things that we had heard from our sponsored clients, focusing on what the panelists have been talking about in terms of reducing the number of potential buyers in an auction, is that some of the bankers who've been doing that, and frankly, for good reason, some of the concern was, hey, you're really reducing the numbers too quickly. In other words, you're going with one horse really early, and potentially you may find that one horse may not be the one that comes up ultimately with the best bid. Did you find that in your practice that that rush to kind of get relevant ever backfired? Because it certainly felt like it might.
Yeah. Well, the trends that have been commented by the panel so far, we've experienced them very much as well. And the joke we kind of make is, you got to be very careful in this environment. It's a most robust M&A environment that we've ever seen, and that's a great thing. And valuations are very high, which is a great thing. But when you have that dynamic where prices are going to be high, there is no discount no one's going to come in and steal a company that's being marketed by one of the members of this panel. And so therefore you get you risk having the restaurant that nobody goes to because it's too crowded, right? So you get literally having phone calls where it's like, geez, great, this is a great business. You guys are going to do great on this one. Congratulations. But you know what? We just can't compete for this. We know that somebody's going to blow the doors off and take this thing off the market. So we would love to own it, but we're just not going to be able to do that and move as fast as knowing what we need to do to win one of these processes. That's what they're making. That determination of whether they compete in that is moving much more forward into the process. They're making that determination far at the beginning. So therefore, in order for someone to actually make that commitment that they're going to commit to paying the market clearing price, they're going to give you a seller-friendly contract, and they're going to do all the work on their own nickel up front. Well, they got to know that they have a high conviction they can actually prevail in that process. And the only way they can have that conviction is if they believe either they have an angle that is either that's primarily relationship based, either with the company or with the banker that's actually running that process. Without that, then you are flying blind, and you can't have the conviction that you need. And frankly, we found that we were doing mostly in our process as the banker itself was really managing those relationships and having those conversations. And I think was mentioned the word transparency, being transparent with the buyers such that we can ensure that people didn't opt out and didn't avoid the restaurant because it was too crowded, but in fact actually committed to moving forward. So the dynamic that you mentioned, you need to be very thoughtful up front about process design, and your messaging up front needs to be very transparent to the buyers. Otherwise, you definitely will risk the process thinning. And we did experience that on occasion throughout, but I think we had to take special care. I think the job of a banker actually changed quite a bit. People think that, well, geez, in this market, it must be really easy, just throw a book out and everyone comes running. It was actually much different. It was I feel like we had to do some of our best work because of you either had those core relationships with the most likely buyers, so they would trust you that it was worth their time and money to compete in those processes. If you didn't invest in that up front, then you were very much at risk of having a process that would be thin at the end, even though you might have a great asset in a great market environment. So it's very interesting to hear the other panelists really echoing our own experience in that regard as well. And nothing has been more important in this market than and when you think about really coming out of what gave people the confidence to transact in the wake of the pandemic in Q2, Q3 of 2020, it was almost entirely based upon relationship-based, high trust-based relationships that buyers were willing to be opportunistic and sellers were willing to be opportunistic because they had that conviction that each was going to live into their commitments. And that's what really we're doing today as bankers, I believe, is being a conduit for people to believe and have trust in the commitments that both buyer and seller are making today because of these dynamics.
So Justin Abloh, Dan mentions the role of the investment banker and how important that is and how it's changed. From your seat at Houlihan, how do you see the role of the banker, and maybe talking about that relationship with the seller and how you articulate reality sometimes, is critical because it's not necessarily what somebody is telling some of the sellers' buddies at the country club is telling them that they can, make for selling the business. It's actually the reality of the market. Talk a little bit about the role of the banker as you see it.
Yeah, I think Bobby nailed it earlier. I think Bruce nailed it. I think Dan nailed it. The roles changed. This is a market where businesses were sold and not bought. I think that's clear. The market that my colleagues described, I think, has at least four sort of corollaries for the ways that companies interact with their bankers. The first was that continuity of banker in the world that they described becomes very important. And for better and for worse, if you're setting up early looks, if you are trying to, often, by the way, which are being set up long before anyone's even admitting to anyone that a quote unquote process is being contemplated. If you are trying to identify those high conviction, most likely buyers early, it becomes pretty important to know which bridesmaids lined up to catch the bouquet at the last wedding. There's a huge premium placed on a banker's already deep knowledge of a company. And incumbency became more important. That's my first corollary than it ever had been. So it's much harder for Bobby to get to sell a business that I had sold to a sponsor than it used to be. Conversely, of course, it's much harder for me to get to sell a business that Bobby had sold to a sponsor. It just became more difficult. Incumbency became more important. Second corollary that's pretty similar is we were often hired pretty early, and it's still the case that we sometimes get invited to big sell side bake-offs and someone says we want to go to market in 2 weeks, come compete with the other 3 guys on the panel this afternoon. That happens, but it's become much more common that we get hired early to help with a measured and very deliberately modulated introduction of a company to the buyer universe. That's just become much more common. And the third corollary is also, I suppose, related, but just moving down the kind of process chain. A lot more third-party work is being done earlier. We have our own fairly robust QOE practice and financial due diligence practice here at Houlihan. But even when we don't use our own folks for a sell-side process, we find that we're spending a lot more time working with market study consultants, with QOE providers, to make sure that we're all independently addressing, the same questions in a manner that's consistent in order to be able to present the right story to help buyers get where they need to be. And buyer diligence, both strategic and financial, and by that I don't mean diligence conducted by the buyer, I mean diligence on the buyer, becomes much more important in a narrow process for the reasons, Randy, that were implicit in your last question, and for the reasons articulated by my colleagues. You simply can't afford to misuse a slot in a narrow process. So we as a firm, and I suspect the other folks here, have invested materially in further expanding our geographic footprint. We now have, I think it's 38 offices or something like that around the globe, in continuing to build out proprietary databases of sponsor buyer behavior, and ensuring that all processes we work on are supported by all the relevant industry experts in-house, so that we understand the strategic buyer universe and have real access to them. The discussions of buyer bids these days tend to be very, very different from the discussions of buyer bids a decade ago. For those of us who have gray hair and remember them, there's a lot of very detailed data that sellers demand about buyer behaviors and capacities now. And in aggregate, I think those changes have really accelerated a long-term trend. I think, as Bruce pointed out earlier, that the COVID, of course, has been the great accelerator. The long-term trend in middle market activity, which is the concentration of middle market activity into 5 or 6 hands, around 4 of whom I think are on the call today. And the good news for all of us is that when we think about our competitive landscape, it's a much smaller group than it used to be. The bad news is that all of us are pretty good at what we do, and we compete pretty ferociously within our market with each other. I'd hate to have to be a new entrant, though, and compete candidly with any of us.
So we're exactly halfway through the amazingly quick 30 minutes. We have another 30 minutes to go. Let's use that time to look at 2022. And Bobby Reifman, give us your view from Lincoln International, what the year ahead is looking like. How would you compare it to the year just passed? And talk about maybe some of the dynamics, that Justin talked about relative to COVID, and are we going to be in a post-COVID world, and how does that matter to your business and to M&A in general?
Yeah, and maybe the initial headline is we're seeing no slowing in the overall activity in terms of 2022 compared to 2021. Everyone on this panel here saw a tremendous 2021, but fascinating. The backlog for us is, I'm sure, similar to others, is up significantly over what it was at the start of 2021. This points to continued crowded market. I think everyone saw similar dynamics where you saw a slowing in the back half or in Q4 last year of new deal launches, just because of how crowded it was with actual deals to get done before the end of the year. You're going to see tremendous uptick in terms of those deals coming to market here in January and February. Now, I also view the world through the industrial lens where I focus, and a couple of things to point to there. One, from the industrial perspective, 2021 was a little bit of a perfect storm where you had 2020 that was, for manufacturing businesses, was off because of COVID, and a lot of those facilities shut down and whatnot, and came roaring back in 2021. You also had, middle of last year, start of last year, views of tax changes that pulled in deals from 2022 to 2021. But the one thing that I think has surprised us overall is just the strength overall of just the industrial markets. And what that's done is it's put more businesses in position to recover quicker from COVID and be able to go out and sell. So we're seeing that backlog very strong going into 2022. I think the biggest interesting point as you think about post-COVID is getting a better picture of kind of what's sustainable, what's the sustainable momentum versus COVID spikes. And a couple examples of that to kind of think through, which we do on our side, is, first of all, the industrial 4.0. When you think about the automation trends, automation was already an attractive growing segment, but COVID really, created this highlighted of the labor shortages, the rising labor costs from the Great Resignation, accelerating these dynamics. And what you had here is a fascinating area that a lot of people wanted to invest in that was just accelerated. Manufacturers need to look for every opportunity to expand automation much quicker than they expected. And the result was kind of automation-related businesses seeing tremendous growth over the last year and exceptional demand from investors, both strategic and financial. Another great area that's very easy to create the corollaries with COVID is the filtration space, where I spend a lot of my time. You always have that need for cleaner water and cleaner air, and it was a growing theme before COVID. But what COVID did is it spiked that. And a way a lot of players in this space thought of it is it took a trend that was going to take 10 years to get to a certain demand level and took it there in 1 year. You think of air purification and the areas of things that used to be nice to have that become must-haves, led to just an explosion in this space where businesses that were expected to be growing at a nice clip of 10% per year were growing at 100% year over year. And so we look at this, and I think it's a great area as you think about 2022 is what are the businesses that had these spikes that are truly sustainable, which you see a lot in the healthcare space and in terms of the automation space. And what are areas that are just COVID bumps that will come back down to earth when you think of PPE, some of those areas related to healthcare. I think a lot of investors are trying to figure out valuations, going back to that topic of, how do you look in 2022 with these businesses that just saw an explosion in 2021? What's the right way to look at those valuations? And that's going to probably be the biggest challenge going into 2022 is there's going to be a lot of businesses out there. There's going to be a lot in the market in order to look at in very attractive spaces. But what's the right way to value those businesses, and what's the right way to approach those to be competitive in an auction process?
Wow, that is a lot to digest, but tremendous amount of great information. Thank you, Bobby. Dan Conlon, let me turn to you because Bobby's talked about his focus on industrials and interesting to hear about automation and how that has changed landscape. I know that you and your firm talk and focus a lot on technology.
Yeah.
Talk about landscape changer. How do you view technology in the current climate going forward, and what, relative to other sectors, how do you think technology is driving change in the current market?
Yeah, and I came to my current role as leading the M&A group at leading our M&A efforts at William Blair through our having led our software team and our technology M&A efforts. So I definitely have a bias towards technology and which also in software, which also touches on healthcare as well. So it was just over 10 years ago that Mark Andreessen wrote that article about software is eating the world. And I think we are seeing even more of that today. I think it was Justin that referred to COVID as being the great accelerator, which indeed it was. We think there's probably 5 years of technology adoption just in the way we all live our lives over the first 4 months of pandemic. Well, that's happening everywhere. And so you take that experience and you meld that through the entire economy. And what we're seeing, the real trend is that we see not only in tech, but we see it going into every single one of our industry groups, is the digitization of everything. And I think Bobby in his comments, I think, was proving that point as well in talking about industrials and automation in industrials and even in the effect it might have on filtration. We see that as a greater theme of digitization and software and just being injected into absolutely every form of business, every walk of life that we see. And so what we have seen is that many of the trends that we're seeing actually in our M&A process, we'd actually seen those trends, the acceleration of the process, the narrowing of those processes. We actually had seen those trends in our tech and healthcare groups even before the pandemic. And we saw that trend continue across all of our other industry groups. We are also seeing a shifting in the outlook of our buyer universes and the traditional commercial or industrial buyers. We are seeing them looking much more aggressively in investing in software. So our buyer lists are evolving to include the traditional industrial players now being included within our technology software processes. They know that they need to invest in technology in order to gain competitive advantage going forward, or even it's really just becoming table stakes, not to gain competitive advantage, but even to stay where they are from a competitive perspective. But literally, we're seeing it affecting in everything. I mean, Amazon bought Whole Foods, so we're seeing the consumer impact of technology is. So we've almost taken a different view where there are areas of convergence that is being led by technology, and particularly software in particular, across every single one of our sector coverage areas. And we think that is going to be a trend that's going to continue for a long time as the world continues to digitize. Our lives continue to digitize, and therefore our corporations and our business activity, regardless of what sector you're in, is going to continue to digitize. And so that's something that we think is going to continue to add fuel to this already robust market that we're experiencing right now. And Bobby made one other comment too about just that there was a little bit of a lull effect because of supply chain issues. I think that where we've seen sectors that have accelerated faster post-COVID than others. And that's where we saw originally the spike within our tech and healthcare practices that has now been matched by our consumer and industrial practices as well. Look, we think it's a major trend. I think it's a major driver, and we think it's actually going to change. It's actually changed the way we do our business. So that by doing so much of it in this type of medium through computer screens, it's dramatically reduced our travel. It's dramatically increased our productivity. And frankly, probably the biggest thing we worry about is just the strain it puts on our own internal teams and and being able to service the clientele that we have. And so we've had to hire aggressively at our mid-tier and make sure they are properly trained so they can actually meet the volume that is that we're now seeing in the marketplace. That'd be a topic I'd love to hear the other panelists mention too, is that we're actually being asked by our clients for references for our mid-level people, because in order to run these processes in the way that we've been running them so fast and accelerated, all that work still has to get done. It has to get done in a much shorter period and all up front. And that puts incredible strain on our own internal teams. And so we've had to invest, frankly, in technology to ensure that we can even deliver upon the promises that to match the demands of the marketplace today.
Yeah, well, I think that's been true on not just the M&A side, but also on the financing side. And we saw it in spades in the fourth quarter, and particularly in December, and just getting deals done. And all of the people, the staff, you have the professionals who are trying to get deals closed during that last fourth quarter. It does put a strain. Talk about supply chain. It puts a strain on your labor force, which is a strain on just the ability to execute effectively. So let me bring Bruce and Justin into the conversation, and maybe on Bruce, starting with you on sectors. So we've heard about the industrials, heard about technology. What's Harris Williams? I know you're kind of a generalist and look at a lot of different businesses, but talk a little bit about the impact, the differences maybe between pre-COVID and post-COVID.
Sure. I think, again, just to echo in my earlier comments, we have, just to level set, we have 10 different industry sectors that we focus on as a firm. And each one of them had kind of phenomenal years over the course of the last called 5 quarters, as I mentioned earlier. And each one remains very bullish as we head into this year. Dan spent time talking about technology. Bobby hit on industrials. Certainly, those are two of our sectors, and I would echo, by the way, what Dan's comments as it relates to sort of technology touching virtually everything we do, and how we approach our clients' businesses, how we staff pitches, how we staff deals. Our technology team is not only developing their own business, but they're also playing important roles in a number of our other kind of pitches and deal executions, because we need to bring that technology expertise and domain knowledge to virtually every engagement, or the vast majority of engagements. But I would tell you, Randy, whether it's our third-party logistics, our transportation and logistics team, our automotive aftermarket team, all aspects, virtually all segments within healthcare, our consumer practice, where consumers, the balance sheet of the consumer is much healthier than it was certainly pre-COVID, and certainly in the midst of COVID, the early days of COVID. So we are seeing folks have seen folks redirect expenditures away from things like travel and into things like sort of the home, because folks are using their homes in different ways, as we all are acutely aware over the last year, than they have in the past. We're seeing segments like kind of outdoor enthusiasts, healthy living, pet. So those are segments of the consumer landscape that we have seen a tremendous amount of activity. Aerospace, defense, government services. After a pretty significant shock to the system as it relates to sort of commercial aviation and to some degree defense, many of those sectors have come roaring back. So I think we are, across the board, while we're cautious and keeping an eye on some of the developing macro trends across the economy, we're feeling pretty good about each of our sectors as we enter 22.
Yeah, that's great. Justin, talk a little bit about your view and Houlihan's view of the economic outlook, and maybe any thoughts you have on sectors that you like.
Yeah, I don't. Thank you. We also go to market primarily through industry groups, and I think I'd share the view that you can't find a pessimist in any of our industry groups these days. If there are no atheists in foxholes, I guess there are no pessimists in investment banking anymore. But I think that there are attractive and less attractive business models inside of each industry group. And I think it's the case that some of the business models that were most attractive over the past couple of years will have a moderate rotation against over the next couple of years. Some of the recurring revenue models, which in the early stages of the sort of work from home era were the most attractive, and maybe in the very early stages, maybe the only businesses that were really saleable. I think those businesses, many of them will have some susceptibility to inflation by virtue of their business models that will make them less attractive going forward. I'll tell you one thing that's sort of interesting is if you just had a casual encounter with a private equity guy, walking up and down Park Avenue, running into him at a cocktail party, whatever, a couple of years ago, he would probably and he was bragging about his portfolio companies, which is something that private equity guys will usually do with very little prompting. They used to talk about how their companies, EBITDA was up from 30 to 40 in 1 year, and that was really awesome. And you'd have to ask a couple follow-up questions to discover that revenue was kind of flat, and that the value creation plan that they had been following with, in that particular example, great success, had really been a cost management and cost optimization plan. Now, if you run into that same private equity guy, he's probably telling you how the revenue has gone from 100 to 200 in that time period, and you have to ask a couple follow-up questions to discover that the EBITDA maybe is flat or down during that period. The very nature of sort of growth has changed. The very nature of the value creation plans that people are executing on has changed. And it's pretty common because of what's going on in the labor market, because what's going on with supply chain crunches, et cetera. It's pretty common to run into these businesses that look very successful on the top line, but might have short-term challenges. And I think the vast majority of them are only short-term challenges further down the P&L.
So if you let me turn to Bobby and Dan a little bit on this. If you think about, and we get asked all the time, what's going to stop this train? Is inflation going to stop it? Interest rates? If we think about the economy in general and sort of what actually, COVID may have been the great accelerator. COVID, we hope, will go away. Is that going to be the great decelerator? It doesn't feel like Omicron has slowed things up much. I think people are now starting to worry a bit about growth for the year. It feels like Omicron, feels like we're back to where we were a little bit in some ways in early 2020. How do you, Bobby, think about, and Dan, think about the rest of the year in terms of what could go wrong, what could be headwinds rather than tailwinds?
Yeah, I think, COVID, people have come to this point of learning to deal with it. We've seen very little blip from Omicron here as we think about impact on our processes and our businesses. It's been fascinating to watch how, compared to the prior waves of what we've seen, it's been business as usual and really hasn't changed anything other than potentially a few in-person meetings, switching back to virtual. For the most part, things have chugged along. The biggest thing on my mind and what we're seeing with our businesses is the supply chain issues, right? There's just massive backlogs. It's incredible to see what's happened where these businesses have incredible demand, massive backlogs, but they're not able to deliver. The theme across a lot of our businesses is, we're making everything we can, and we've got demand for more than that, and we just can't deliver on it. We've got product just sitting out in the ocean on ships, and we can't get to it. And the question becomes, when will that kind of be a tipping point where it could impact businesses in terms of their ability to deliver to their customers and what that may mean for the future. And I think that's probably the biggest risk, because everything we've heard is those supply chain constraints are going to be there for at least another 6 months, and it's going to be something everyone's dealing with. People are still doing great in terms of the demand they have, but at some point, does that become a tipping point where either they just can't deliver or prices just get just ridiculous? And you're seeing that with freight and whatnot in terms of the squeeze on margin with a lot of businesses, given some of those supply constraints, is starting to be seen. We saw that in the fourth quarter, and people have a very careful eye on, is the profitability of these businesses changing going forward, and that's creating some questions. Outside of that, it would take a pretty, I think, extensive external shock of just something unknown to throw us off this train, because there's just a lot of demand out there, money to be put to work, and a lot of businesses that are doing well that are in saleable positions.
I'd just add the point. I totally agree with all of that. I'd add the point that when the supply chain issue is resolved, it is unlikely to be resolved by a return to the status quo ante. And there will be serious changes to the configuration of the supply chain, right? There'll be reshoring. There'll be things that are, multiple source that used to be sole sourced.
Yeah.
There'll be changes. And whenever changes like that are going on that sort of scale, there'll be a number of tremendous beneficiaries.
Yeah, that's the biggest fight right now in terms of businesses is you look at businesses, their final performance in 21, and maybe profitability was off a tick because of some of the supply chain constraints, and you say, hey, it's an add back related to the fact that that's just not normal, it's extraordinary, and the seller's position is going to be it's going to go back, and the buyer's position is going to be, hey, we're never going to get back to where it was in terms of what the costs were for some of those containers. And that's a lot of the push and pull we're having happen right now is, is there truly an add back related to this that people should be taking into account as they think about what's the go forward profitability of these businesses.
So want to get the rest of the panel in on this as well. Interest rates. The Fed's going to hike 3 or 4 times this year. Of course, I keep saying in our commentary in the lead left, okay, that means that the Fed funds rate is going to be 1%. All right, it was 5.5% in 2007. Do we think interest rates are going to have any impact on? I mean, obviously, some sectors like financial services potentially more than others. What do we think about interest rates, and do we think that inflation in general is going to be transitory in the sense that it's going to go away in 2023 and it's going to be back to where kind of a 2 to 2.5% level a year from now?
Yeah, Randy, I'll jump in here. I mean, clearly the public markets are off to a very choppy start this year, obviously, given these very issues in large part. We haven't seen that sentiment impact, the timing of, deals in the private market, the world that we live in terms of deal launches. We are certainly mindful of it. We're certainly mindful of all the above. Supply chain matters, labor shortages, inflation, the impact inflation has on rates. There's clearly, as you mentioned, the Fed's going to raise rates here, X number of times this year. Is it going to be 3? Is it going to be 4? Is it going to be greater than that? So we are mindful of all the above. I think our general view here at Harris Williams is we still remain firm believers in the ongoing economic recovery. So all of our sectors will continue to face, headwinds here and there, and these are among them, the ones we just mentioned. But it will be the management teams that have the greatest degree of sophistication in dealing with these issues, to again echo Dan's point, that are sort of embracing and leveraging technology in all aspects of their business, and are focused, to Justin's point, on things like nearshoring or reshoring their supply chains and being innovative and flexible in how they manage their supply chains. It's those businesses that will continue to command attention and premium valuations when they go to market. So I think we will likely see rates continue to drift. Our crystal ball is as murky as the next person's, but we, against that backdrop, we remain optimists. No surprise to Justin, as it relates to the year ahead, and the sectors that we focused on for businesses that, again, have highly sophisticated, seasoned management teams and are high-performing businesses. I think the challenge will become, to some degree, and we overuse this term, and nobody wants to admit to being a B-level asset, but it's those companies that can't check all those boxes that perhaps will have a more difficult time, transacting at valuations that the owners feel are compelling.
Yeah. I think Bruce just made an incredibly important point, and I wanted to extend it one bridge further when he talked about management teams and the great management teams being able to navigate what's going on now. I'll add that ownership matters. I'm a private equity guy, and I'm sort of a big believer in the private equity model on a number of levels. People often talk about private equity, but they, in different contexts and capacities, but they sometimes forget to talk about it as a governance model. And I think that private equity as a governance model is unusually well equipped to manage change. And as we move into a paradigm change now, I think that private equity ownership, in partnership with the management teams that Bruce was just mentioning, are unusually well equipped to manage that change. And there's an argument, sort of the efficient frontier for what companies should be owned by private equity and should not, sort of shifts in times like this. And there's a real argument that a private equity owned business is going to be able to navigate these challenges in a different way from an entrepreneur-owned business, from a family-owned business, for that matter, from a publicly owned business. And I think that's going to be sort of a difficult M&A driver to spot, but I think that somewhere in the background, that M&A driver will lurk.
Yeah. If I could pick up on where Justin left off, I think we're in those instances, and we're seeing this already, in that we feel that we are being called upon to in our advisory role to be much more of a holistic advisor, as opposed to showing up and simply pushing M&A or simply one product. And I think as we enter forward with maybe some emerging complexities, that is going to, I think those firms, private equity in particular, are going to be looking for more creative ways in order to address the issues that they're seeing. And we're already seeing that in a lot of our transactions that we've been a part of. Right now, this the breadth of available options that are out there for private equity to drive value in their companies is extraordinary. I mean, we've seen the rise and fall of SPACs. We see the shifting of strategies, whether it's control investing or minority investing, in these high valuation environments. We've seen the emergence, a very strong trend toward shared governance transactions, which is being a bridge, especially in a high valuation environment, how you can actually take money off the table yet still maintain your seat at the table. These are all factors that are as this world continues to be more and more complex, and this massive amount of dollars is looking for alpha and looking for angles, a broader perspective on what we bring into our advice to our clients is going to be required. And that's also going to require us to, like, we're seeing a lot of our teams are growing. We're adding more and more product people to our deal teams. We're seeing our sector teams come together in order to address some of the technology angles that we talked about earlier. So it's adding complexity to, and I think frankly, it's going to have us all have to up our game and bring a more holistic approach to the advice that we give, as opposed to maybe relying upon some of the one or two tricks that maybe got us to where we are today.
That's great. So we are almost at the end, but I want to get one last question in, and it's going to have to be short answers. So one sentence answers if you can. And we didn't rehearse this ahead of time deliberately because I wanted to get your honest, candid opinions on this. But when we reassemble, let's say at the end of the year, because I hope that we bring the same panel back, what is going to be the biggest surprise in 2022, looking back, in January of 2023? And Bobby, why don't we start with you and go around the horn? Biggest surprise.
Yeah, I think the biggest surprise from what we're seeing right now at the start of this year is just how strong 2022 is, and the amount of deal flow that we're going to be sitting here having a conversation similar like we had at the end of 2021 of, man, what a year. It's incredible the amount that happened. I think you're only going to see an acceleration out here in 2022. I don't see anything other than some external shock factor to the system slowing things down. And I think people are going to be surprised just how strong 2022 is on top of 2021.
Okay, Justin?
Besides consolidation among middle market investment banks, I'm saying that we will no longer need to have SPAC panels by the end of 2022.
Sounds good. Bruce?
I think it'll be really interesting to see how the virtual dynamic sort of takes hold or doesn't take hold throughout the course of the year. In other words, is it a resumption to sort of the normal way of conducting business? Or are we going to be back on the road in force from a coverage point of view, from a deal execution point of view, in all aspects of what we did sort of, up into March of 2020, or to what degree are we going to leverage this technology tool? I'm a firm believer that it has its place and it's a great complement. But I think all of us are itching to get back on the road and see one another in 3D. And hopefully we do that in 2022.
Getting by to Zoom is tough. And Dan, you've got the last word.
I think we're going to be very pleased at how little we're talking about the pandemic and COVID. We'll talk probably some, but not nearly. It's been so consuming. I think we're going to be very happy to look back and say, wow, we're not talking about that nearly as much as we used to. And I think I'm in agreement that we were shocked that 2020 was a great year from our business perspective. maybe not anything else, but from an investment banking perspective, it was tremendous. We never thought we could, 2021 could be what it was. I think we'll have a similar view towards 2022, although I think it's going to be a much different mix of how it comes together. I think we're going to be surprised that 2022 was strong in relation to 2021. And I think, like I mentioned, COVID, I also think we're going to be surprised of how our lives, the adjustments that we made in the way we work. So I think we're really going to find out what that new normal is, as Bruce is mentioning. We're going to find out what the new normal is post-COVID by the end of the year.
Well, I look forward to reassembling and hearing how right you all were. And I want to thank our speakers, Justin Abelo, Dan Connolly, Bruce Kelleher, and Bobby Reifman. I also want to thank our producer, Sherry Chen, who did an amazing job putting this all together. And thanks to all of you for attending. Stay tuned this year for future webinars. If you have any specific suggestions on topics, please send them along. So until next time, for all of us at Churchill and Lead Left, thanks for joining. Stay healthy and stay safe.